Hi there, in this video, I will continue talking about the revenue cycle. In the previous video, we went through the documents, the departments, and the accounts of the revenue cycle. Then we discussed the inherent risks that might show up in the revenue cycle and the audit procedures in the revenue cycle. If the client has good control, we make test of control like inquiry, inspection, observation, and reperformance. Otherwise, we make substantive procedures. And one of the good examples as substantive procedures in the revenue cycle is confirmation. We send the confirmation to the client. If we ask the client to reply back, we call it positive confirmation. Otherwise, we call it negative confirmation. In this video, I will take you through the risks and controls in each part of the revenue cycle. So first, let us make a recap for what we discussed in the previous video, which is the beginning and the ending of the revenue cycle. So usually we receive the customer order by the marketing department. Then we send it to the credit department to check the credit history of the client. And once we get the approval, we go to the warehouse to pick up the items, pack it, and ship it to the customer. Then we issue the invoice to the customer and then collect our money. So this is in brief the revenue cycle. What are the activities that might be involved in the sales or revenue cycle? First, we receive the customer order. Then we deliver the goods, issue the invoice to the customer, collect our cash, check that the cash has been deposited at the bank. How about the journal entries that are involved in the sales transactions? First, we issue sales, whether the sales for cash or credit, and then we get the cash receipts once we collect our cash. And if the customer made any returns or ask for any allowance, we put both of them into one account. And then if the customer fails to pay the due amount, we make write-off for the uncollectible accounts, and then we create the bad debt expense. So as you can see the difference between this list and the previous one, here we talk about journal entries. In the previous slides, we talk about the activities in the sales. Now let us go through the risks and control in every department of the revenue cycle, starting by the order department, the order entry. So usually we get the customer purchase or contracts either by document, or we can get it by phone or through the emails. And then we prepare the sales order. For the sales order, we have one copy goes to the customer, another one by the credit department. And here the original sales order must be signed by the customer, and the credit manager has to approve the sales. So we need to know that there are good controls in every department, and in the order entry department, the good control if the credit manager check the history of the client and makes the approval or disapproval. Here is the point that we get the purchase order here, and the purchase order should have pre-number. In case one of the order was missed or lost, we can trace it. And then the purchase order number must appear in all the shipment there as a good reference for that. And then we have the sales order. Also, the sales order should be pre-numbered. And we have the approval of the credit manager to make sure that every order has gone through the same procedures of credit approval. The risks and control at the shipping department. The shipping department is usually receiving the sales order that has been approved by the credit manager, and then prepare multi-part bill of lading. The bill of lading is the legal document that the carrier is required to have. The bill of lading is usually issued by the company with several copies. One copy goes to the customer. Another one is filed in the company, so we can keep numerical file. The other two goes to the accounts receivable and billing department. And here is a sample copy of bill of lading that has serial number, and it should be controlled numerically. In case one bill of lading is lost, we can trace it. The risks of control and controls at the billing department when we issue the invoice. So once we get the order, we send it to the bill of lading or the carrier or the shipping, and then we issue the invoice. Why do we do that? To make sure that the invoice has been issued on the quantity that was actually shipped to the client. So we get the bill of lading and the sales order that has been signed to prepare the invoice, and then we have sales summary at the end. The invoice, as you can see, it has multiple copies. The invoice should have pre-number to check any missing invoice. And the invoice goes to the customer, the original one, and a copy. And we might wonder, why do we send an original and copy to the customer? So that the customer can sign the copy that he received the original and it's matching to the sales order and the bill of lading. Then we have one copy goes to the cost department for perpetual inventory. And then we have the bill of lading and the sales order attached to the invoice to prove that what the customer ordered is shipped and billed. Okay, and here we make summary for all the sales, and the pricing, of course, should be checked, and numerical number for any missing invoice. So here is a simple copy of the sales invoice that shows that the sales invoice has serial number, and it's also initialized for the pricing, that it's correct, all the prices, and the account is correct. The sales journal here, once we make the invoice, we put it in the sales journal, and we need to differentiate between the fraud that might happen in sales and error. For example, the fraud here, like recording sales without receiving customer order. And this we call it a channel stuffing or sham sales or intentional over shipment of goods. As I said, we might sell extra quantity to the client and ask the client to return it back at the beginning of the new year. Holding the sales journal open to record next year's sales. So we might make sales in January, like 1st or 2nd, but record it as sales in December. The errors that might happen in sales transaction, like record sales based on the receipt of the orders from customers rather than the shipment of goods. We make sales based on the actual quantity we ship, or inaccurate billing and recording of sales. And this could happen, so maybe the accountant might reverse the numbers in the invoice amount. Recording cash that represent a liability as revenue. And finally, recording sales in the wrong period. As I said, we might face the cutoff problem. The accountant might not have an intention to record it as fraud, but by mistake, he recorded in the wrong period. The risks and control at the cash receipt or treasurer department. So here, when we receive the cash from the customer, usually the check comes with the remittance advice. The remittance advice has all the information that is included in the invoice. And then based on that, we make cash receipt listing that shows all the checks that came from all the clients in one day. And then we add the machine tape, and then we prepare the cash summary. So here we have cash receipts comes from the customers. Cash receipts came from the cash sales. We prepared cash summary for that, okay? And then we take the cash to deposit it in the bank. So we have the remittance advice, the invoice copy, the checks, where we prepare the cash list. And then we have the remittance advice, invoice, and the checks goes to the cashier. And then we start to prepare the cash deposit. Okay, the cash must be deposited in the bank every day to avoid any kind of fraud. So once again, we make separate department here to ensure that the person who received the checks are different from the person who deposited the checks in the bank. okay? So here the distribution goes to separate department for reconciliation. Then we have here the sales, the deposit slip to prove that we deposited all the amounts into the bank, and it's stamped here by the teller, okay? And then we deposit it in the cash receipt journal. So we go from the sales to the actual cash receipt, and then it goes to the journal. The next one is the risks and controls at the accounts receivable department, where we make the journal entry. We usually get here the cash receipt summary. We make the list of receipts with the remittance advice, and then we record it in the cash receipt and the accounts receivable and make sure that they are matching. So here the posting to the accounts is separate from the collection. As I said, the key control is to make segregation between the different jobs to avoid any kind of a scheme that might be happening in the collection cycle. The subsidiary customer accounts posted from the remittance advice, and make sure that the subsidiary accounts receivable are equal to the general accounts receivable, so we have matching between the two numbers. The general accounting, as I said here, we have the accounts receivable department. They make the sales summary and they post it to the general ledger, and then we make list of receipts and the credit summary. Okay, and finally, I make a list here of all the test of controls for the management assertions. What are the management assertions? Existence and occurrence. It means the sales happened actually at the end of the year. Completeness means that the transactions have been recorded in the journal, ledger, trial balance, that we have the rights for the sales that happened. It's not on consignment. And we have obligations in form of warranty. And then if something happened to the value of the accounts receivable, like bad debt or something, we have to reflect the actual value of the accounts receivable in the balance sheet. So what are the controls and the test of controls? First, we make segregation of duties between the different jobs and observe and ask the management about that. Then we make monthly statement, we send it to the customers, and here we check the manager, ask the management if they are actually mailing the statement to the customer. Then we use control listing to control cash collection, as you have seen in the previous slides, that we make the cash receipt summary and then the deposit in the bank, and then we record it in the cash journal. So here we ask the management about the process and make some kind of reconciliation. Use budget and analyze variance to make sure that the actual cash is meeting the budgeted cash amount. And here we check any variance. Excuse me. So the bank reconciliation here, it's a good control that will show that the company is making the actual cash in the account. The company has the rights and the obligation for the cash and the valuation. If we make pre-numbering to the documents, this will meet the completeness assertion and the cutoff, so everything has been recorded and recorded in the right period. If we make credit memo for authorization, this will satisfy the assertion of completeness and the valuation and accuracy. If we use a chart of accounts and an independent review, this will meet the presentation and disclosure. And here are the typical test of controls that we can do. Finally, the substantive procedures here, we obtain age listing of receivable and reconcile it to the ledger to make sure that the value of the accounts receivable are correct. We might inspect the notes on hand and confirm those not on hand to ensure that the existence, the occurrence, and the rights assertions are satisfied. We might send a confirmation to the client to check the existence, occurrence, rights, and obligations. We might make some analytical procedures to also satisfy the existence of occurrence, rights, cutoff, valuation, and accuracy. We might review the year-end cutoff sales for satisfying those assertions. And finally, verify the interest earned on notes receivable to make sure it has been recorded in the ledger. So I hope through those two short videos, you get an idea of the audit procedures we make it on the revenue cycle. Thank you so much. Bye-bye.